one story that really stood out yesterday and caught a lot of attention, and we did actually see a move in the markets off the back of that, was the unveiling of the new AI chip, the Trainium. There's been a lot of talk about how, this could potentially be another challenge to Nvidia, which obviously dominates the GPU market, but also to Google as well. They said it would be available starting from yesterday. It's already in some data centers. They're going to be really rolling this out come next year. How significant is that?
So AWS has been on a path with Trainium. This is their custom in-house developed silicon. That we're on the third generation now. That was what went GA. They announced that. And they also gave us a preview into Trainium 4. So this is a consistent strategy from AWS. It was interesting. They talked about their partnership with Nvidia, and then instantly went on to then talk about their in-house custom silicon with Trainium. So they've also got Graviton, which is their in-house CPU developed architecture. So I think what we're seeing here is that a rising tide is going to raise all boats. I don't see this as a zero-sum game between Nvidia and the likes of the new Ironwood TPUs from Google and what AWS announced yesterday. I see it that there's so much inference workloads going to be out there that we're going to need those types of announcements. Another organization I track, Volta, announced $1 billion partnership with AMD to roll out their infrastructure. So I think what you're going to see, Sam, is a lot of silicon, both from storied names like Nvidia and AMD, but also from the hyperscalers developing around silicon. What we're going to see is explosive demand. Does that balance out market share over time with Nvidia? Probably. Do I see that impacting Nvidia in the long term from a revenue growth and margin perspective? Absolutely not.
What was the nature of some of the conversations around, what we're seeing here in the technology space, particularly around, the degradation of moats? Because the last couple of weeks, it's been a conversation of, Nvidia versus, your Google Alphabet. We saw a bit of a change in leadership there as far as some of the conversations getting a lot of praise around Gemini. Then yesterday we had this report out about OpenAI going code red. I mean, how is Amazon thinking about this right now?
So from the conversations, I spent some time with their senior leadership. I've got time with Matt Garman later on today. What I'm hearing from these guys is their ruthless focus and dedication to what those enterprise customers need. AWS has been always touted for its focus on end user customers and what they need, and that's coming through. So they're just taking step after step. We saw Nova Forge. We saw focus on a raft of new agents for security and DevOps and various other things coming through. There was 25 announcements, as I say, speed run through, focused on the core infrastructure, what they're doing in compute, what they're doing in object storage. I also spent some time with their leadership yesterday around cross-cloud networking. So they're really focusing on some of that foundational layers and what companies need in order to deliver AI at scale. So I think what we're hearing is, whilst other organizations are maybe over-rotating and focusing on their frontier models, and AWS has got those as well with Nova, but what we're seeing others focus on 10-second sort of cutesy video clips. What we're seeing AWS do is be ruthless on focusing on what their enterprise customers need in order to deliver.
Nvidia's stock has increased 2.0% during the last week due to news of strategic alliances with Mistral AI, AWS, and Synopsys. Additionally, there have been rumors that Meta and Amazon are among the businesses investigating or creating their own internal AI chips or thinking about utilizing Google's chips. Nvidia's stock has risen 32.1% since 6 months ago, comfortably surpassing both the Nasdaq and the S&P 500 during that period. Although economic ties between the United States and China pose challenges, Nvidia is the market leader in AI chips and its profitability is still high. This is a look at the potential direction of Nvidia's stock for the remainder of this year and the upcoming year. It should be noted that the chipmaker's recent advances helped erase the sharp decline in stock prices that occurred in early 2025 when it said it would incur a $5.5 billion loss related to export restrictions for H20 chips to China. Although some analysts have increased their price estimates, others warn of persistent challenges brought on by the uncertainties surrounding future trade relations between the United States and China, as well as the possibility of more stringent restrictions. The data center segment's robust growth contributed to the third quarter report's excellent top and bottom lines. The company's decision to invest in AI infrastructure in the United States shows perseverance in spite of its difficulties. Wall Street examines if Nvidia can maintain its recovery and spur additional growth as analysts look at the strong demand for data centers. As it negotiates trade constraints between the United States and China and high market expectations, Nvidia faces formidable challenges. The significant write-down mentioned above occurred in the first quarter as a result of export regulations on its H20 AI chip, which was created especially to get around export limitations on cutting-edge technology to China. Analysts projected a $9 billion revenue loss as a consequence of the ban. The first quarter's fiscal performance would be impacted by about $700 million, with the remaining $8 billion being distributed across the second and third quarters. As competition from Huawei's Ascend chips increases, supply chain costs are also at risk because to U.S. tariffs and China's punitive actions, especially for components imported internationally. Analysts warned about margin pressure due to these issues. Nvidia's profitability is still strong, though. Due to the taxes, the company reportedly increased the prices of several of its most popular GPUs by 10% to 15%. In order to offset rising production costs and maintain steady profits, the price of gaming processors increased by 5% to 10%, while the price of high-end AI GPUs increased by up to 15%. However, Nvidia's supply chains are strengthened by investments in U.S. AI infrastructure, which are backed by its $37.6 billion cash reserve and Taiwan Semiconductor Manufacturing's $165 billion development of its Arizona fab. During his recent visit to South Korea, CEO Huang declared that Nvidia will provide over 260,000 GPUs to South Korean companies, such as Samsung and Hyundai Motor. According to him, AI has entered a virtuous cycle in which advancements in the models spur additional funding, which in turn spurs other advancements and funding. He added that he hoped the U.S.-China trade negotiations will result in a policy shift that would enable Nvidia to start selling cutting-edge chips in China again. Grand View research projects that the AI market would expand at a 37% CAGR through 2030. This helps Nvidia reach its revenue target of $170 billion in fiscal 2026, which is 30% more than the $130.5 billion it made in 2025. Nvidia reported a record-breaking $57.01 billion in sales for the third quarter, of which $51.2 billion came from its data center division. Due in large part to the fervent demand for its AI chips, the total increased 66% year-over-year. In fiscal 2025, the chipmaker expanded Blackwell accelerator manufacturing and AI infrastructure by investing $3.2 billion in capital expenditures. To fulfill hyperscaler demand, the company's capital expenditures have increased by more than 200% this year, reaching over $3 billion. Trade restrictions between the United States and China continue to be risky. Even with a possible thaw, tariffs could increase prices, which would account for the purported price increases. Nvidia's $37.8 billion adjusted operating income was offset by a 36% increase in operating expenses to $5.8 billion for R&AMP. However, data centers are not the only factor contributing to Nvidia's expansion. Thanks to partnerships with Toyota and Aurora Innovation for autonomous vehicles, the company's automotive division grew by 32% year-over-year to $592 million. In light of tariff uncertainty, this diversifies Nvidia's holdings. Nvidia's third quarter fiscal revenue is expected to be $65 billion, give or take 2%. This view surpassed the consensus forecast of analysts. For Nvidia shareholders, this year has been somewhat turbulent. In April, the stock fell to $86.62, a 52-week low. The share price rebounded following the first quarter results and an apparent halt in U.S.-China tariffs. In October, it reached a record high of $212.99, bringing the company's market capitalization just over $5 trillion. Analyst sentiment is still positive, despite the fact that at least one officer has continued to sell shares. 11 of the 60 analysts who urge purchasing shares, out of the 64 who cover the stock, have strong buy ratings. They now have a consensus one-year price target of $250.66. That aim indicates a potential upside of almost 38% from the present price. The range of targets for each share is $140 to $352. Recently, buy equivalent ratings were maintained by Citigroup, JP Morgan, Morgan Stanley, and other companies. The target price for Evercore ISI is street high. Strong demand for Blackwell chips, an improved supply chain, a sizable pipeline, and faster revenue growth were all mentioned. However, well-known investor Michael Burry has a negative opinion on Nvidia. Nvidia was positioned for success in 2025 thanks to its supremacy in AI, 93% growth in data centers, and automotive alliances with Toyota. But care is needed due to tariff risks and DeepSeek's competitive AI algorithms. Nvidia's financial buffer and Stargate project role provide stability, while the rise of the AI market and the chipmaker's $47 billion second quarter revenue position it to reach its $170 billion full-year revenue target. However, there are still issues with value. Growth-oriented investors should purchase Nvidia, but others should proceed with caution. Nvidia's year-end price objective of $233.16 per share, or a 28.5% gain, is set by Wall Street. This estimate takes into consideration anticipated Blackwell supply restrictions, DeepSeek competition, and tariff threats. It also shows Nvidia's dominance in AI and their revenue forecast for the second quarter of 2026. According to a press release, Hewlett-Packard Enterprise increased its collaboration with Nvidia and established an AI factory lab in Grenoble, France, to evaluate workloads based in the EU. Fanuc's stock increased when the company said that it would use Nvidia technology to create robots that could respond to spoken orders. According to Mizuho analysts, over the next 2 to 3 years, Nvidia's addressable market may expand from chip design to system-level engineering as a result of the Synopsys partnership. Although they applauded the actions, investors warned that execution risk and competition from Google's Tensor processing units could cause gains to fluctuate. Nvidia revealed the most recent of several partnerships and investments focused on AI. The eye is investing $2 billion in Synopsys, an expert in electrical design automation, EDA. Even while Nvidia's involvement raises the stakes, it's crucial to stand back and consider the wider picture. The introduction of ChatGPT on November 30, 2022, commemorated the third anniversary of the artificial intelligence AI revolution. As a result, technology underwent a paradigm change, propelling mankind forward. Nvidia has emerged as a key player in the AI sector as the inventor of the graphics processing units, GPUs, that support the technology. Investors searching for a competitive advantage closely examine every move the company makes. With billions of dollars invested in 6 AI-focused businesses and significant agreements with a number of others, Nvidia has given investors much to think about since the beginning of AI. The company announced another strategic investment only this week, this time in one of the top chip design companies, Synopsys. Let's examine Nvidia's most recent action and see if investors ought to do the same. The two announced a multi-year collaboration aimed at broadening the scope of Nvidia's popular Compute Unified Device Architecture, QDA, a collection of software tools intended to assist developers in utilizing the raw computational power of Nvidia's GPUs in a joint press release released on Monday. The deal covers Omniverse digital twins, physical AI, and agentic AI in addition to CUDA. Research and development teams will be able to build, simulate, and validate intelligent devices more accurately, quickly, and affordably, thanks to the combination of Nvidia's AI expertise and Synopsys' industry-leading engineering solutions and chip design know-how. Additionally, Nvidia declared that it had acquired about 4.8 million shares of Synopsys ordinary stock, valued at about $2 billion. The specifics are fascinating. Synopsys will speed up its chip design process, also known as electronic design automation, EDA, by utilizing Nvidia's CUDA libraries. This entails a number of processes, such as designing the chip and employing molecular simulations, electromagnetic analysis, optical simulations, and more, to digitally confirm that the chip's physical architecture can be produced effectively. In addition, the two will collaborate to create the next generation of digital twins, which are virtual representations of real-world items that help advance a number of industries, including semiconductors, energy, automotive, aerospace, industrial, and healthcare. Together, Nvidia and Synopsys can provide GPU-accelerated engineering solutions that are ready for data centers and the cloud. Even if Nvidia's large acquisition of Synopsys stock is fascinating, it's important to stand back and consider the wider picture. The $2 billion investment in Synopsys would account for only 3% of Nvidia's AI-focused assets, since the company and its venture capital division, NVentures, have made 117 investments totaling more than $62 billion since the beginning of 2024. Additionally, Nvidia and OpenAI announced a $100 billion cooperation in September. However, the funds are only available if OpenAI constructs and deploys 10 gigawatts of AI data centers based on Nvidia's GPUs. This demonstrates how Nvidia's assets are dispersed throughout the AI ecosystem. Thus, its investment in Synopsys isn't as solid as it might first seem. Color can be added by looking at the company's recent performance. The stock plunged 35% when Synopsys revealed earnings for its fiscal 2025 third quarter, which concluded on July 31st. Earnings per share, EPS, fell 43% to $1.51, while revenue of $1.74 billion increased 14% year over year. The segment's sales fell by 8%, and management blamed the deficit on its design intellectual property, IP. The fact that Synopsys cut its fourth quarter guidance to $2.25 billion, which not only fell short of Wall Street's forecasts, but also fell short of management's prior forecast, may have been more worrisome to investors. The company's performance was impacted by costs associated with finalizing the Ansys purchase and export limitations from China. The high valuation of Synopsys is the last factor to take into account. Despite its recent decline, the stock is selling for 34 times earnings, which is a high price to pay for a business that is dealing with a lot of problems and is adopting a more conservative view for the fourth quarter. Even though Synopsys might do well in the long run, I wouldn't purchase the stock simply because Nvidia did after taking a step back and considering the wider picture. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.